Thank you for coming to this presentation of mine. The topic of my paper is the tax treatment of collective investment schemes portfolios in South Africa, assessing implications and alternative solutions. I am Professor Riley Carpenter, and my student and colleague is Dean Kietzmann and Tracy Johnson. The outline of this presentation is I'll start off with the background to the CIS industry. Providing some clarity on the industry I think is important before we look at the tax treatment. I'll then go into the research question and the methodology. Thereafter, I'll look at the taxation of the proceeds of disposals within the collective investment scheme portfolios. I'll look at case law, and then I'll propose alternative solutions and come to a conclusion. For those of you who aren't tax experts, I've tried to make this presentation as inclusive as possible, but that does mean apologies to my tax colleagues who may feel that some of the presentation may be a little bit too simple, but let's see how it goes. So firstly, in terms of the background to the CIS industry in South Africa, the industry plays a very prominent role in the country, specifically relating to savings and the economic landscape. Back in June of 1965, one fund began the industry, and now we have more than 2,000 portfolios as of the end of last year. We have assets under management exceeding 2.6 trillion rand. And so therefore the tax methodology and treatment of disposals is extremely important. Given the sheer size and scale of the industry, any incorrect tax approach could lead to substantial revenue loss for the fiscus. But not only revenue loss for this fiscus, it could also lead to individuals disinvesting in the industry because they don't want to pay the tax. There are a number of key stakeholders in the industry. Firstly, if you look at the portfolios are governed by the Collective Investment Schemes Control Act, or CISCA. The registrar of CIS also oversees the portfolios. There's a trust deed, which is an agreement between the portfolio manager and a trustee. And that trustee monitors and reports on that CIS manager's administration of the portfolios. That includes investment limit compliance, CISCA provisions, etc. The trustees safeguard the assets that are held in the portfolios in the best interest of the unit holders. One party that I don't have there on that slide is the auditor. So an auditor is required to be appointed, who then oversees all of the reporting. Unit holders invest in a portfolio by purchasing participatory interests, which are called units. And those unit holders participate in the returns and losses of the portfolio in proportion to their interest in that portfolio. So the CIS industry is very highly regulated. There's independent oversight from both the trustee and the auditor. So my research question is, what is the impact of the proposed amendment to Section 25BA of the South African Income Tax Act on the CIS industry? Or more specifically, what potential issues may arise from this proposed amendment, and then what alternative solutions can we suggest to mitigate those concerns? In terms of our methodology, we use a doctrinal research methodology with document analysis and textual analysis. What we specifically looked at is we looked at the legislative framework governing the CIS managers and portfolios, submissions made before National Treasury. We looked at case law precedent from South Africa. And then we also looked at publicly available documents from CIS managers, from ASISA, National Treasury, the FSCA, SARS, as well as the JSE. So how are proceeds of disposals taxed in South Africa? So those proceeds on disposal can either be revenue or capital in nature. If they are capital in nature, there's a capital gain or loss. However, those capital gains or losses are disregarded. If the proceeds are revenue in nature, then Section 25BA applies. And currently, in terms of legislation, it says that the portfolio must determine whether those proceeds are capital or revenue in nature. Now, while that question is undetermined, essentially every single circumstance or every single transaction, you need to look at the facts and circumstances of that transaction, as well as precedent from case law. The proposed amendment to adjust Section 25BA says that financial instruments, which are essentially all of the investments that the CIS portfolios invest in, financial instruments disposed of within 12 months of acquisition will result in proceeds that are revenue in nature. This essentially results in the unit holders being taxed at their maximum, well, not maximum, but they'll be taxed at their marginal tax rates. However, what are the consequences of this proposed amendment? So firstly, there's incongruency with the investment policy. Managers of the portfolios are required to abide by the investment policy that's stipulated in the trust deed. And so now they may be influenced to hold a particular financial instrument for longer than what they should, just to ensure that the disposal is seen as capital rather than revenue. They may also elect to dispose of assets trading below their purchase-based costs prior to the 12-month period in order to realize a loss on that disposal. There are different tax treatments for the unit holders. So managers face the near impossible task of weighing up the interests of different participation interests in the portfolios. For example, there could be retirement funds who in South Africa are not taxed, who may be investing in the portfolios compared to a natural person who would then be taxed at the normal tax tables in South Africa. With respect to withdrawals by unit holders, now portfolio managers may be forced to sell instruments against their intentions. Because a unit holder who seeks to redeem a sufficiently large investment, they may trigger portfolios having to sell other instruments, some of which may have been held for less than 12 months, in order to redeem the units from that one unit holder who wished to redeem their investment. From an index fund perspective, forced disposals to mimic an index fund could realize proceeds that are revenue in nature, while actively managed portfolios could continue to hold those same investments or those same financial instruments until the proceeds would be regarded as capital in nature. In terms of treating customers fairly and recharacterizing of proceeds, the FIAS requires the financial service providers, i.e. the CIS portfolios, to disclose all material tax matters that investors should consider. On top of that, CISCA, the act governing collective investment schemes, also requires unit holders to be given enough information so that they can make an informed decision. But this proposed amendment in the legislation doesn't invalidate our revenue authority, SARS's ability to go back to retrospectively raise an additional assessment against the portfolio. And so therefore, the proposed amendment doesn't provide certainty and makes it difficult for investment managers to discharge their duties. And lastly, another potential consequence is looking at derivative instruments. The derivative market in South Africa is large, and the vast majority of those contracts have a term less than 12 months, which means that the disposal thereof will result in proceeds that are revenue in nature. From a case law perspective and looking at precedent that has been established in the country, firstly, we look at an intention, and essentially there, we look at what the taxpayer's intention was when the asset was acquired, and whether there has been a change in intention from that date until when the asset is disposed of. From a length of time perspective, the longer generally an asset is held, the more likely the proceeds of the sale of the asset are capital in nature. However, our revenue authority, SARS, has agreed that the manner in which the asset is dealt with is more important than the length of time held. And so something that is held for a short period of time could still result in proceeds that are capital in nature. The proceeds from sale from a CIS perspective, you look at both the fee or all of the fees, the income earning structure, as well as the fruit versus tree principle. CIS managers earn either performance fees or fixed fees, but that's based on the assets under management in their portfolios. And unit holder inflows, as well as manager growing those assets, result in an adjustment to the proceeds. Then if we look at an income earning structure, the income earning structure is capital in nature, while the operations are revenue in nature. And then lastly, income is what capital produces. And that's similar to the principle of interest or fruit, as opposed to the principle or tree. So what alternatives could be proposed? The first alternative is to classify each portfolio individually. However, what that means is that the CIS portfolios are required to invest per the investment mandate. So if a mandate specifically says something, then the portfolio manager must be doing or operating that portfolio in that particular manner. And so therefore, the selling of an instrument that has been held for only a number of months wouldn't be inconsistent with a portfolio that seeks to grow capital over the long term. CIS portfolios are established through trust deeds, and they outline the investment mandate and objectives. And if a portfolio adheres to its mandate, regardless of that holding period, whether it's short or long, all those proceeds may be argued to be capital in nature, especially if the portfolio is focusing on long-term capital growth. From a supporting record perspective, the portfolios are required to provide detailed reports to external stakeholders. I mentioned previously that there's significant oversight. And in this case, our revenue authority, SARS, can request records from the portfolios on a regular basis. The FSCA conducts on-site visits at the CIS managers, and if there is any non-compliance that's uncovered during those inspections or investigations, then SARS can be prompted to investigate further. And conversely, if FSCA looks at some of the reporting, they could then provide any information to SARS that may be relevant if needed. And so let's assess this alternative that has been provided. Firstly, it does present some challenges and potential costs for SARS. Some portfolios may not fit neatly into the capital or revenue categories. Some managers who have ambiguous investment objectives may dispute this, although personally I would say, well, then they need to choose whether their portfolio is going to be capital or revenue. This alternative does discourage artificial arrangements aimed to avoid tax, and it also promotes transparency in the reporting. It simplifies the tax treatment, and it aligns with the principles of awareness, ease of compliance, and enforcement. It also avoids excessive admin burdens that could hinder any trade or growth or development. The second alternative that I am proposing, or that we are proposing, is introducing holding periods for the unit holders. The unit holders are responsible for their tax that must be paid. However, some unit holders may face higher taxes due to being invested when instruments are being disposed of less than 12 months, because the proceeds in that case will be included in their taxable income, compared to in South Africa, if you're taxing capital gains, if you are a company, only 80% is included, and if you're a natural person, only 40% is included in your tax calculation. If you have these holding periods, unit holders may engage in portfolio switching in order to chase performance, and so to avoid that, these holding periods could be introduced. So assessing this alternative, in this case, the unit holders are being informed of their obligations, or they would normally be informed of their obligations. The CIS portfolios have uninterrupted operations. Nothing will be adjusted from the CIS portfolio perspective. It doesn't burden the managers excessively. They just need to provide that information to the unit holders. It avoids the drawbacks that I've previously discussed, like the pressure on the managers to operate outside of the mandate, penalties for index funds, limitation on derivative instruments, etc. And yeah, the unit holders will have control over their tax treatment. And if they do have control over their tax treatment, then this may promote savings and discourage switching in the short term. So therefore, in conclusion, the CIS industry in South Africa is vigorously regulated. There are multiple layers of oversight and reporting. The CIS portfolios don't deviate from the investment mandates unnoticed. It does get picked up by either SARS or the FSCA. The proposed amendment that the Revenue Authority is suggesting creates difficulties for the industry as well as the unit holders. And so we have proposed two alternative solutions, the portfolio classification or the holding periods. We prefer the holding periods because it aligns better with the goal of tax compliance and our Revenue Authority's principles. The CIS managers can easily provide guidance to the unit holders to assist with them deciding what they would like to do from a tax perspective, and therefore it benefits the majority of stakeholders. Thank you.